Hello, this is Domenico with Easynomics, and today we're going to look at a particular requirement from the IB for higher level students within the context of theory of the firm. Within the economic guide under 2.12, it states the market's inability to achieve equity required by the HL student to be able to illustrate this and explain this. We can see here it says workings of free market economy may result in unequal distributions of income and wealth, and the diagram that could be required of us, showing the circular flow model to illustrate why the free market results in inequalities. In a previous video, we've looked at the Lorenz curve and the Gini coefficient. The Lorenz curve and the Gini coefficient is part of macroeconomics, but at the end of micro, as we finish up micro and we get into theory of the firm, there's this last content requirement of us that's asked of us by the IB, which would later link to aspects of macroeconomics, the distribution of income and wealth. So from a microeconomic model, using the circular flow, we can begin to understand how there is a disparity between rich and poor in developed and developing nations. So I'll put a link to the Lorenz curve and the Gini coefficient, which I've taken snapshots of and put into my whiteboard here. So we'll just go over this, and then we'll start looking at the circular flow and trying to understand how is there a unequal distribution of income and wealth. So in that previous model video that I'll link again below in the video notes, we had a table illustrating the income earned by different quintiles, and quintiles are groups of 5. We divide the population into groups of 20, the lowest 20%, the cumulative next 20%, 40%, the next cumulative 20%, so a total of 60%, and so forth. And we're looking at the distribution of income over basically a half century from 1970 to 2021. And the IB can give us data, particularly on paper 3. Here we have table 1 showing us the distribution of income in 1970. Here we can see that the lowest 20% or the poorest 20% had 4.1% of the total national income. And then we can see that 50 years later, it's been reduced to 2.9%. So the poorest 20% of the United States has been much worse off over half a century of economic growth in the United States. We look at the second quintile, the next 20%, and we add this up. We add 4.1% of total income to 10.8% of income that's held by the second poorest 20% of the population. We get 14.9 total, and we can plot that point, which is this blue line here, which is curve A, Lorenz curve A, and so on. And so in that video, we just plot all of this, and we then compare where's the United States in 1970, which is this, actually it's a purple line, and I'll illustrate that again. All right, it's this purple line that was illustrated in that previous video, plotting the distribution of income in 1970 across the U.S. population. The x-axis is measuring the cumulative percent of the population. On the y-axis, we're measuring the cumulative percentage of income. And we're seeing how far away are we from the line of perfect income equality. That line of perfect income equality shows perfect distribution, so that you would have the lowest 20% having 20% of the total national income, and the cumulative 40% having 40% of the total income, and 60% of the population having 60% of the total income, and so on. So here we can see that this shaded purple area is relatively far from the line of perfect income equality. And the goal is not to be on it, but we would expect that a developed country would have their Lorenz curve being shifting towards a line of perfect income equality. As the nation grows, GDP rises, we would hope that there'd be a more equitable distribution of the income generated from the productivity. However, we see by 2021, the Lorenz curve is getting worse. It's shifting away from the line of perfect income equality. So the Gini coefficient value would be getting closer to 1 as opposed to 0. And again, this is all discussed in a previous video, which I'll have linked below. But I'm using the United States to highlight that over half a century, income distribution has been getting worse from 1970 to 2021. If we look at real median family income and productivity, we can see from post-World War II to about 1980 approximately, they're very strongly correlated, which would make sense. In GDP, we assume the value of output is equal to spending, and spending is equal to income. I earn $1, I spend $1, and the $1 I spent is equal to the good or service that I bought. And so we can see that that's more or less true. As we produce more in the United States after the war into the 50s and 60s, median income in the United States is rising along with that productivity. And we can also see from 1965 and 1975 approximately, real median income is actually greater than productivity. So that was a period of significant economic growth, rising incomes distributed fairly well across the United States. But from 1980 onward, that changes. From 1980, we can see that incomes in the United States are now below productivity. And this is the period of the Reagan administration. In the UK, Margaret Thatcher comes to power. And this is the beginning of what we call supply-side market-based policies, where Ronald Reagan, with Reaganomics and Thatcherism, was getting towards freeing up the market economy, less government intervention, less government regulation, and encouraging firms to be more productively efficient, making it easier for them to hire and fire labor resources and so forth. So from that point on, and due to technology, let's not neglect the impact of technology and how capital resources can produce more. And as productivity rises with capital resources, with technology, and perhaps labor not contributing as much to production, perhaps, we see real incomes declining and flattening out. It's actually flattening out. And I was listening to a recent podcast, I think on Freakonomics, where real median income in the United States, yeah, it was Freakonomics. Real median income in the United States has not really budged over, I think, the last 30 years or so. But don't quote me on that. But there was a recent Freakonomics podcast about this. So as productivity rises, GDP is rising, but incomes are falling. So there's going to be a worsening distribution of income and definitely wealth in the United States. And if we look at the World Bank providing some data on the Gini index, where we want to be closer to 0 than 100, we can see that the U.S., which is the top line here, the U.S. from 1965 to 1980, the distribution of income was improving. We're getting a better and better distribution of income. But from 1980 onward, it's getting worse. Income distribution is worsening and worsening. And then we can see it's kind of stagnating in the 2000s onwards. But it's definitely worse than other developed countries. Other developed countries have much lower Gini indexes, closer to 0, better distribution of income in this case. So we can see with Germany, they were trending towards better income distribution. Then it was getting worse in the 80s. And then it's actually improving. It's going back down slightly. With Canada, oh no, I'm sorry, the green was Canada. I was referring to Canada the whole time. So Canada being a good comparison. Canada is our northern neighbor in the United States, holding variables constant, similar geography, similar capitalist system, perhaps in Canada, better provision of public health care and so forth, better distribution, maybe a better progressive income tax system, is leading to a better distribution of income in Canada relative to the United States. Germany, on the other hand, has been getting worse over time. We see the distribution has been getting worse. And with France, it's declined and then gotten back up. But Germany, Canada, and France, their distribution of income is much better than that of the United States. So the U.S. being the most powerful economy in the world is producing quite a bit, but maybe not as much of it's trickling down to the lower income groups. So there's Wikipedia pages. You can definitely Google and research more about income inequality in your particular country or in the United States. Income is different from wealth. Income, we know, is generated from the factors of production: land, labor, capital, entrepreneurship, which generates wages, interest, profit, and rent. And with income, you can decide to save it, to spend it, or to invest it, and you can invest in wealth. And wealth can include the ownership of a home, a car, personal valuables, jewelry, perhaps fine works of art, owning a business, your savings, your investments in stocks and bonds are all associated with wealth. But one cannot really engage in wealth if you're just surviving, if you're just generating income and using your income to cover your necessities and you have no savings left on the side. You can't really invest and accumulate wealth. So let's get back to what the IB is wanting us to illustrate. So here we have down in the lower right corner our typical circular flow model. And I'm going to separate out two households. We assume that the households includes land, labor, capital, and entrepreneurship owned by the household. But if we separate labor, households that only own their labor, from households that are the entrepreneur, we can then begin to understand the unequal distribution of income and wealth in the United States. So let's just go ahead and fill out the circular flow as we've done. And there's be a link to videos on how to do that as well, but we'll just do a little review. And so the household that owns labor, they're seeking to maximize their utility, their satisfaction, and they're going to offer labor in the resource market, and in return, they will generate a wage. A wage is provided back by the firm for the employment of labor. So here we see from the resource market, wages going into the household, labor being offered in the resource market, and labor then being employed by the firm. The firm has to pay for the labor, so these are costs of production, and one of those costs includes wages. So the firm is providing costs, which are wages for the labor, and that those wages goes to the household. Labor is used as an input in the firm to produce some type of good or service, some type of product. So coming out of the firm is some type of product, some type of good or service that's offered in the product market, maybe in a retail shop where you buy that good or service, and the household then takes that good or service back home. So we understand that labor offered by the household, they are helping the firm to generate some type of good or service, and later on the household is able to acquire that good or service with the wages that they have earned. So here we have a wage, and wage for the household then becomes spending or consumption to acquire that product. And that spending by the household then becomes revenue to the firm. And the revenue is used to cover costs of production, such as wages. So that has been covered before in the circular flow. You are knowledgeable of this. But now let's separate out the household where it's the entrepreneur, which is different from labor. And the household, as the entrepreneur, is seeking to maximize profit through the firm that they own. So here I'm stating that the firm, connecting it to theory of the firm, is actually a monopoly, or perhaps it's a collusive oligopoly, and they want to maximize their profit. So up here in theory of the firm, we have our monopoly or collusive oligopoly. So we'll go ahead and draw that. We're going to have our marginal cost curve going down. The law of diminishing marginal returns sets in. The marginal costs rise. So that's going to be our marginal cost curve. And then we'll have it intersect with our average total costs, costs on average per unit at its lowest point. And there's other videos that I have on theory of the firm that explains this in more detail. And then we'll go ahead and add our revenue curves. And our revenue curves are going to be relatively inelastic. This firm is offering a unique good. They face no strong competition. So I'm going to have kind of these chopsticks being relatively vertical, going down to show the inelasticity of the demand curve, because it's a monopoly, it doesn't face competition. There are no close substitutes. And our demand is equal to marginal benefit. It's also equal to our average revenue, the amount of money we make per unit on average. And then below the average revenues, we're assuming that the firm is not seeking to price discriminate. I have another video that explains that. So here we have our MR curve. And we've learned in theory of firm that in order to maximize profit, to maximize pi for profit, the firm's going to produce where the marginal revenue is equal to the marginal cost curve. And that's where the profit function is at its maximum. So here's MR, here's MC, and they intersect at that point, and that's going to set output by the monopolist. They're going to underallocate relative to where is allocative efficiency, and I'll show that in a second. This will be the quantity at profit max. And then they're going to price according to their demand curve. This is what people are willing and able to pay for that particular good or service. So here we have price, which is equal to the average revenue. And then we're going to see what's the cost on average. And the cost on average is right here, our average total costs. I'll call that C1 costs, which is equal to our average total costs for that quantity of units at quantity profit max. And then I can highlight the area that is the abnormal profit or the supernormal profit for the firm. And that profit's going to go to the entrepreneur. They're going to take that to their household. So there we have the profit that's highlighted. It's abnormal, extremely high profit. So you can think of Jeff Bezos owning Amazon, or the founders of Google, or any other type of large monopolistic or oligopolistic firm. They're generating significant profit, all right, as a result. The monopolists, they have the power, they have the market power to price high. And as they price high, that reduces consumer surplus. So consumer surplus is reduced. Consumer surplus is the area below the demand curve up to the price that they pay. So if we extend that, oops, it's a little bit messy. Here we have this reduced consumer surplus because the price has gone up. And the producer surplus has been expanded. You're getting this additional area. If it was allocatively efficient, if the firm is seeking to produce the quantity that is desired by society, we would have more output. It would be at this point. So this is where MC, marginal costs, equals marginal benefit. We'd have more output at this point. I'm running out of space. I can say maybe this is just quantity at allocative efficiency, where MB equals MC. And we would have a lower price for the consumer, and that lower price would increase consumer surplus. So here is a price, and I can now make a note. This is where marginal benefit equals marginal cost. So we can see the monopolist has the market power to raise price against the consumer, less consumer surplus. They're going to amplify their profit. In addition to that, we must take into account that profit is equal to total revenue minus the total costs. And total revenue is a formula. It's price times quantity. And what the monopolist, the entrepreneur, is seeking to is they want to raise price and also increase quantity by expanding their demand curve, maybe through economies of scale. They're going to get that demand curve to shift out through, they're going to seek to try to increase the quantity that they're selling, maybe by altering people's tastes and preferences for their particular product. And also they will achieve economies of scale, which will shift out their supply curve and reduce their costs on average as a result. And they will become the cheaper alternative, and that will help to increase quantity and perhaps also enable them to maybe higher price or be the cheaper substitute and sell many units at a lower price and destroying their competition in the process, like Amazon is doing. You can say that Amazon is able to provide very competitive prices to increase consumer surplus. They have achieved significant economies of scale, but they are in the process destroying a lot of competing firms. Well, overall, increase total revenue, perhaps raise price, raise quantity. And what about total costs? Total costs are your fixed costs plus your variable costs. And your variable cost includes wages. So what is the entrepreneur going to do if they want to maximize profit? They want to lower wages or find ways to pay less in wages, or perhaps substitute labor for capital, maybe use more autonomous technology, robotic technology, AI technology. That's all going to help to reduce wages for those households. So now we're beginning to understand how monopoly or collusive oligopoly in a free market system, as they're able to have the comparative advantage and produce more and build economies of scale and reinvest their profit in building scale, and how they can drive costs of production down, which might also include labor, or utilize technology to replace labor, then we can understand the divide between households that only have labor and households that are just the entrepreneur, which can help us understand why the income distribution in the United States is getting worse. All right, this is a very simplified explanation, but this is what the IB is trying to get us to think about. So let's look at the household. All right, household owns the household of the entrepreneur over here, seeking to maximize profit. They're running their firm, their monopoly, or their oligopoly, or their collusive oligopoly, and they're paying those costs, and they're trying to drive down wages, which is going to reduce wages for the household, and it's going to limit their spending, or it might push the household to borrow, to go into debt, to maintain their lifestyle. And we would typically see that as wages goes down for labor, we would expect the amount of spending on necessities to be greater than their spending on luxuries, as they're falling into poverty over time. In the other case, as cost of production, wages are driven down, that allows the cost of profit to rise. So the firm's going to pay out their profit, but as they reduce their wages and their other cost of production, that's going to increase those profits. And those profits are going to go to the household that owns entrepreneurship. So here we have this line extending out, and that is profit going to the household that is the entrepreneur. So here we see profit for the household rising. In return, they're offering their entrepreneurship to the firm. They're leading that firm. They're running that firm. I don't have much space, but here's the entrepreneurship going to the resource market, to the firm, and in return, they're getting rising profits at the cost of wages falling. And that will enable the household that owns entrepreneurship to acquire goods and services from the product market. And they will do that through their spending. So here we see the spending coming out from the household that is run by the entrepreneur. Over there. And we would notice that for the household that is maximizing profit, generating more profit at the expense of falling wages as they run their company, we would see in this case their spending on luxuries would be much greater than their spending on necessities. And then we can connect that to income elasticity of demand within microeconomics, which is, I have other videos to explain that. So I'm hoping that in this video we're able to understand what the IB is requiring us to do here for 12.12. Workings of the free market economy may result in an unequal distribution of income. Income being wages from labor, rent from land resources, interest from capital resources, and profit from entrepreneurship. And we are distinguishing between the household that's generating a wage and the household that's generating profit. And that distinction is helping us understand that unequal distribution in income, lower wages for the household with labor, higher profits for the household that's the entrepreneur. And the higher profits for the household that is the entrepreneur will enable them to acquire more wealth, more stocks, bonds, real estate. We can see that here in the United States. I think this is that the top 10% of the United States is holding much more family wealth than the other, let's say, 90% of the United States. Okay, so we've used that diagram, we've illustrated the circular flow, we've expanded the circular flow and separated out labor and the entrepreneur, and hopefully with this we can understand these connections with our monopoly model, YED, circular flow, Lorenz curve, Gini coefficient. I will put some notes in the video notes below, some outlines about what we just discussed, and that's it. If you have any questions, feel free to comment those questions, and don't forget to subscribe and to like. Thank you so much.